What are the typical ways a syndicator such as yourself makes money in these deals?
Primarily three ways. One is acquisition fee, two is asset management fee, and three is your equity ownership in the deal. Every deal is structured, well, every deal could be structured differently depending on who's putting it together, what is the business plan, what's the opportunity, what are the projected profits. But what I found the typical fees for a syndicator to be one is the acquisition fee, which tends to be anywhere between 1 to 5% of the purchase price. So if it's $1 million purchase price, then acquisition fee would be $10,000. If it's 1%, if it's 2%, you do the math, right?
Right.
The asset management fee tends to be a percent of the collected income that the property generates on a monthly basis, anywhere between 1 to 3%. Is the asset management fee. And again, depending on the deal, depending on the business plan, depending on the operator's experience, the risk profile of the overall deal, these percentages can vary. But anywhere somewhere in that range tends to be typical.
What does asset management mean? Because I know it's not property management.
It's overseeing the property management company.
Okay.
Which, from an outsider standpoint, that might like, come on, you're getting paid to oversee
2%
someone else who's overseeing it. It's like a Seinfeld episode. But the reality is, it's necessary. That was a major mistake I've made in the early days when I was doing syndication. Is I treated it like my single family home portfolio. And instead, I have to treat it, and anyone else who's doing this has to treat it like a business. And you have to continually look at the business and the financials and how it's operating and where you're at relative to the business plan. We've got debt financing. You got to make sure where you're at in the market and the business plan. What does your debt look like? How many years left of interest only, if any, do you have on the loan? When is it due? When does the defeasance or the prepayment penalty burn off? I mean, there's all sorts of things we've got to take into account. And me too, whenever I got started. It was over my head when I got started. But there's all these things that we've got to take into account. So that's what asset management means. One way I've seen the asset management fee structured, which I do not like, but I've seen it in other people's private placement memorandums, PPMs, is a fixed fee per unit per year. So $250 is what I saw per unit per year, asset management. The reason why can you guess why?
Doesn't align with your investors.
Nailed it. Yeah, doesn't align with investors. Exactly. Property could be losing $10,000, and
you're still getting
getting $250 per unit per year.
Yeah.
Bad showman, just bad all around. And then the third way is equity ownership in the deal. That could be 50-50, that could be 60-40, 70-30, 85-15, 75-25. And when I'm using those two breakouts, it's limited partners, so passive investors, and general partners, people who are putting the deals together.
Okay.
It just depends on experience level, the deal, if there's a preferred return or not. Preferred return is allowing the limited partners, the investors, the passive investors, to get the first portion of the cash flow before the general partnership. So there's a lot of different variables involved there. But those are generally the three main ways that apartment syndicators make money. There are other ways, miscellaneous, depending on where they're at. There could be a loan guarantee fee. There could be and that could be a percent paid at closing. from 0.5% to 1%, 2%. I mean, it just depends. Every deal could be different. There could be a refinance fee where if you return 75% or 50% or whatever percent of the investor equity back to the investors on a refinance, then the general partnership could get a 2% fee of the original loan balance at closing. I mean, there's all sorts of different ways you can structure it. I mean, ultimately, taking a step back, though, the most important thing is to have alignment of interests with investors and to be paid for performance. So the acquisition fee is paid for putting the deal together, finding the deal, getting all the pieces in place. The asset management fee is paid for performance of the deal. The equity ownership is paid where you get a large chunk of money after the investors receive their returns. Because with a preferred return, what that means basically is that investors, let's say it's a 5-year plan, investors every single year must get 8% on their money plus their money back before the general partnership receives a split of anything from the profits from the sale.
Okay.
So, when you have that equity ownership, it looks good on paper, but you really got to deliver to the investors in order for you to make a payday on the back end.
Do you always do preferred returns
Always.
for the investors?
Yep.
That makes sense. Did you keep up with, obviously not looking for any details, the one you saw that had 250 per door per month asset management fee? Did you keep up with that? Did it turn into a nightmare? Do you know? Or
No, I just saw the offering.
oh, okay.
One of a friend of mine was looking at it. He sent it to me and he said, "What questions would you have?" And that was one of the questions I would have. And I don't know if he ended up investing or not,
Got it.
or what the deal is.
I was fishing for a horror story.
Yeah,